Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 9, exercises Group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that's a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Before I jump over to problem exercise 9-33, I realize that if you're watching these videos that all of this sounds repetitive. I keep on putting this at the front of the videos and I keep on saying it again and again and again, but that's because I want to drive home the fact that things are not cut and dried. It's not about looking up something in a book and then copying it. At the end of the last video, it was that the last exercise was a simple bond problem. Okay, it didn't take into consideration discounts, premiums, things like this. Okay, these problems will, and the exercise before it was amortization, and it's like, okay, this amortization to me is just so easy, but if you don't understand how to do amortization, then if you have a discount or a premium, you're dead in the water. You can't do the problem. And amortization is an underlying concept. All right. So make sure that you get the theory down and realize that you can't just copy out of the book. You can follow along in the book. And that's the whole idea of how you understand the concept, is that you follow it along. You see how the pieces fit together, and when you start seeing new twists to the concept, you're storing that information in your mind so that when you come up with a problem, I've seen that situation before, I have an idea as to what I have to do with it. So with that said, now we're moving over to 9-33, and even though it says accounting for bonds, you can't just read this and treat it like it was the previous exercise, because if you do, you're going to get it wrong. All right. So January 1st, Doherty issues a 5% 10-year bond payable with a maturity value of $90,000. Okay, the bond sells at 95 and pay interest on January 1st and July 1st. Doherty amortizes any bond discount or premium by the straight line method. Record A, the issuance of the bond on January 31st, which is kind of like what we did in the last exercise. And B, the semi-annual interest payment, right, which is kind of like what we did in the last exercise, and amortization of bond discount or premium on July 1st. Well, if you just went and said, okay, the issuance of the bond on January 1st, and you treated it like you did in the last exercise, you're going to get this wrong, because it says the bond sells at 95, okay, which is a discount, all right? So your issuance, your journal entry for the issuance is not going to look like the same entry you made in the last exercise, and neither will the payments look like it, all right, because we're dealing with a discount. And if you didn't understand the idea of the discount here, go back and watch the theory videos, all right? Just briefly, the bond at par is 100, and it's being bought and sold on a secondary market. I also, just as an FYI, the bond market is twice as big as the stock market. Okay, but when you look at the internet and you see on the news, you hear about this company stock, that company stock, and every so often you hear about bonds. Okay, where because of the interest rate, the bonds aren't given as much fame, publicity, but the reality is the bond market is actually twice as big as the stock market, right? So when a bond is issued, it's issued at par at 100, and depending upon what it's selling at, whether it's 105 or it's 95. Okay, 105 means it's selling at a premium. 95 means it's being sold at a discount, right? Because we're selling it for, at 95, we're selling it for less than the par. All right, so Let's draw a timeline so we understand where we're at. So this is January 1st. Okay, it's at 5% for 10 years, 90,000. Okay, and the next payment will be on July 1st. All right, which is 6 months. Right. So then that next payment will be on December 31st. Okay. So by being on the 1st, we're not going to have to worry about an accrual entry for interest when we get to the end of the year, right? Because it's 6 months and we hit that, we make that payment on the last day of the year, so we're paying out the full amount of interest on that date. Okay, and that's different from the previous problem. Just realize that you're not going to have to make that accrual entry. Your payments are going to look exactly alike, on every July 1st and December 31st. All right, so we're going to record the issuance of the bond on January 1st. All right, so January 1st, when we issue the bond, what are we getting back? All right, we're getting cash. All right, so we're going to debit our cash because we're selling the bonds. But the question is how much are we getting? We're not getting 90,000. 90,000 is the par value of the bonds, but they're being sold at a discount of at 95. So you can multiply the 90,000 by 95%, right? Because remember, at 90,000 that's 100%, right? And if we multiply 90,000 by 95%, we get $85,500 in cash. Now, the bond itself is 90,000. We're going to owe that 90,000 sometime in the future, right? So we'll credit our bond payable because we owe it, and that's for 90,000. Okay. Now that we've figured out how much our cash is and we know what our bond payable is, debits have to equal credits. And notice what I'm doing. I'm backing into my debit here, all right? The difference being $4,500. Well, debits have to equal credits, so I'm going to debit something else. So what am I debiting? I'm debiting discount on the bond payable, right? And you see how, as long as I was able to calculate my cash, all right, I can back into that discount, all right? And I have the correct journal entry, all right? Okay, so if you didn't understand that, go back and watch, the theory videos. Okay. All right, now it says B, the semi-annual interest payment and amortization of the bond discount. So on July 1st, so on 7/1, what we're going, we have to pay, we have to, calculate our interest, all right? So we're going to have to pay out, we're going to have to pay out the interest on it. So we're going to credit our cash. Okay, and how much cash are we putting out? Okay, well, we're putting out the 90,000 at 5%, and it's for a 6-month period, right? So 90,000 times 0.06 times 5 is equal to 27,000 divided by 12, and that's equals 2,250. So we're going to credit our cash for 2,250. We know we have to pay that amount out, right? We also know that we're going to debit our interest expense. Okay, but we don't know how much that is at this point in time, for the simple reason that we also have to consider our discount on our bond payable, right? we have to amortize the discount. So if the discount on bond payable in our initial entry was a debit, that means we're going to credit our discount on the bond payable. Now, we need to calculate how much that discount is, right? Well, if we had, if our discount is $4,500, right? And we're going to amortize that over the entire 10-year period, okay? And since we're making 2 payments a period, right? 10 times 2 is 20 payments, right? So in order to amortize it, the 4,500 over that full 10-year period, we divide the 4,500 by 20, and we end up with 225, okay? So each and every period, we're going to book the 225 to offset the discount on the bond payable. So now debits have to equal credits. So if I add my 2250 plus my 225, right, that gives me 2475 is how much I'm going to book in interest. Okay, and that's my entry to record the semi-annual interest payment and the amortization of the discount, which allows me to back into how much my interest expense should be. Okay. So, that's it for this problem. I worked through the steps and, realize that this here entry is the entry that you're going to make every time. We did this for July 31st. It's going to be the same entry we'll make on December 31st, right? And we'll just keep on making that same entry for the life of the bond in and of itself, okay? But notice what we did, all right? As a quick recap, every 6 months we have to pay the interest, right? Somebody's going to walk in and say, I want the interest. Here's my coupon for this bond. So we calculated the interest that we're going to have to pay out, okay? But unlike just having a bond at par, right, we also have to take into consideration our discount. So we have to amortize the discount, right? Here was the discount, and here's the discount, and we amortized it, figured out what the amortization is going to be, and we have to include that because that's an expense to us each and every period, all right? Because we're not getting the full value of the bond, all right? We're not getting the full $90,000 of the bond, all right? We're getting only $85,500, and the difference between the two, because remember, we're going to pay out the $90,000, all right? So we're losing $4,500 when we get to amortize that. So when we amortize it, that's $225 of an additional interest expense that we can gain. So we back into, by knowing what our cash is, knowing what our discount is, we're able to figure out what our interest expense is just by adding those two together. All right, and that's how we back into that number. If you tried to calculate the interest expense by itself right up front, you'd end up, going through these steps anyway. So work it in that order in order to come up with that journal entry, right? And again, if you don't understand the theory here, watch the video again. Definitely go back and watch the theory videos, all right? If you still don't get it, feel free to contact an instructor, and I'll see you in the next video for the next exercise.